If you've ever wondered how serious real estate investors scale up, especially in expensive, high rent markets like Boston or anywhere in the Northeast, today's video is for you. By the end of this video, you'll know exactly what DSCR means, how banks use it to approve investment property loans, and how you can use DSCR loans to add more rentals to your portfolio, even if your personal income or tax situation is complicated. I'm Jarrett Lau. I own over 50 plus cash flowing rental properties here in Greater Boston. And I help investors build real wealth through smart, numbers driven real estate decisions. So let's break down what DSCR is and why it matters and how you can use it to unlock your next investment property. DSCR stands for Debt Service Coverage Ratio. Simply put, this is the number that banks and lenders use to decide whether your property makes enough money to safely cover its own loan payment. It's a way to answer the big question. If we give you this loan, is the property's rental income strong enough to pay us back? Here's the formula. DSCR is your property's monthly income, usually gross rent, divided by the total monthly loan payment, including principal, interest, taxes, and insurance. For example, let's say you find a triple decker in the Dorchester area with 3 units, each unit renting for $2,200. That's $6,600 in gross rents each month. If your all-in mortgage payment is $4,800, you divide that $6,600 by $4,800 and you get a DSCR of 1.375. Most lenders want to see a DSCR of at least 1.2. That means your property brings in at least 20% more than it owes each month, giving you and the lender a safety margin for vacancies, repairs, or the unexpected. The higher your DSCR, the more attractive you are to lenders, the easier it is to get approved, and often the better your loan terms will be. So why does this matter so much in the Boston and the Northeast? In our market, prices are high, rents are high, and the traditional loans often require you to prove personal income or provide mountains of paperwork. That can be a challenge for self-employed investors, business owners, or anybody who writes off a ton of expenses at tax time. DSCR loans change the game. Instead of focusing on your job or your tax returns, the lenders look at the property itself. If the building cash flows well, you can qualify even if your personal finances are complex. And here's what makes DSCR loans such a powerful tool. They're designed specifically for the investors who want to scale up. If you're focused on growing your rental portfolio and you want a streamlined approval process, DSCR loans let you leverage the strength of your properties, not just your personal income. If your numbers work, you're in a strong position to buy, refinance, or expand faster and with less friction. But remember, DSCR loans are all about the math. If your DSCR is below 1.2, you may need to improve the property's income, negotiate a better price, or increase your down payment. If you're above that 1.2 mark, you have options, and the higher, the better. So before you can even make an offer on your next property, run the DSCR calculations yourself, take your projected rent, divide it by your monthly loan payment, and see where you land. That one number can open up doors or save you time chasing deals that won't work. If you want my step-by-step DSCR loan checklist, everything you need to qualify and prepare, drop your city in the comments or DM me DSCR and I'll send it to you. Or if you want to run through your numbers on a specific deal, reach out and I'm happy to walk you through it. Subscribe more for Boston-specific investing tips and strategies that you can actually use. In my next video, I'll break down the real numbers behind the BRRRR method and show you exactly what to watch out for before you try it in our market. If you found this video helpful, share it with another investor, and let's keep building wealth the smart way. DSCR loans are one of the best tools out there for growing your rental portfolio, if you know how to use them. I'll see you in the next one.